Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Happy weekend, happy Saturday morning, or whatever time of the day it's going to be, or whatever day it's going to be when you watch these. We are back again for another weekly market recap. So happy November too, because it's a new month, right? We just wrapped up the month of October. And as you can see, we just went through Halloween. So I hope you had a very good night, assuming you're still young enough to go out seeking and chasing monsters and witches. And if you are, well, props to you, because that's one of the rare occasions throughout the year, if not the only one, I think, where it's allowed, and maybe it's safe, to accept candies by strangers, right? Now, after the bad joke, let's move on to what's really important. Now, from the econ calendar standpoint, there is not a lot. We are still under government shutdown regime, so data points are just not released. The only thing which caught my attention was ADP basically announcing that report that they always put out once a month about, the labor market data, and especially the unemployment or employment situation, basically payrolls, right? It's gonna see an update, which is going to be weekly this time around. So, they have provided labor data to the markets and the financial world for, I guess, 20 years now, and they are trying to improve it, which for me, it's kind of a plus, because I've always said how laggy and how quote-unquote corrupted or unreliable, let's say, BLS data can be. So it is a nice addition, and I'm definitely not arguing against it. Now, moving on quickly, because I don't think there is a lot. I mean, the big focus of the week was around the FOMC meeting and the interest rates cut decision, which, of course, it was already anticipated and telegraphed by the Fed. So let's move along. Now, break-evens, they're not moving a lot. Like, okay, they got this spike the previous week, and now they are just stable around, 2.4, more or less, for the red one, which is the 5-year break-even, should be 2.4. The 10-year, it's still around 2.3, something like it, right? So what could be, if you really want to split hairs, a little bit different is the trueflation reads. So now we got PCE going up, and it's going up quite substantially now, still confined in this range right here. But, that was an increase recently, so 2.74 for now. And even the headline CPI as calculated by Trueflation, it looks like we finally broken out of these highs right here. And we are kind of getting in line a bit more with what was the latest CPI print as for the headline, so the official data. So now 2.71, I guess the latest one was 2.9, all 3%, kind of like that. So that divergence we were looking at, it's kind of fading out at this point. Could this be we are kind of sentenced for another inflation spike? Too early to tell, for me at least, too early to tell. GDP now wasn't updated. I mean, it was, but 3.9, next update will be next week. As I said in the past, I'm not really putting a lot of weight on this one. I'm more interested in what would be the projection for year end, quite honestly. And again, I think it's going to come around 2% plus or minus a few basis points, and then we'll see. Credit spreads are still particularly tight. Therefore, this chart is going toward lows, so not a lot of risks in the credit market. Although, I mean, we have seen last week, we have discussed about this story about the subprime auto loans getting a little bit out of whack, with a few shadow banks kind of blowing out, and these car lenders posting what turned out to be bad collateral, and therefore, people are starting to question the collateral. as I said, I still think it's not a major thing. It is going ahead, like it is proceeding, but it's not really escalating to the levels which would be worrying for the entire system as a whole. But it looks like the Fed, it's kind of monitoring the situation. Now we got the cut, but as you can see, the odds for another cut in December dramatically shifted lower. Like when I checked throughout the week, we were looking at values above 95%. And after the conference, Jay Powell talked, of course, and there was this shift, like 30% shift, more or less, because I remember there was still the possibility for a 50 basis points cut, which was contemplated by this chart right here, and it's not there anymore. So what could it be? Well, I mean, I guess Powell had to kind of walk on a tightrope, so to speak, or on a razor edge, whatever. He had to cut, right? But then he had to add that they were stopping QT starting December the 1st. And maybe, it is, of course, it's just my interpretation. And maybe he had to put in at the end, right? The December cut, it's not a foregone conclusion. Far from it. Like, it's not a done deal. Actually, quite the opposite. Kind of letting out that maybe we won't see another cut in December. I think it's all, as usual, it's all a for show. Like, if the economy keeps on rolling like it's rolling right now, which again, it's slowing down, not crashing, no recession yet, but kind of slowing down, normalizing, so to speak, I think he will have to cut because they are still in restrictive territory, right? But maybe he didn't want to, how would he like to put it? In order to not let inflation expectations go in unanchored, I need to put in at the end that we are not so sure that we are going to keep on cutting on the next meeting. So that, I give you a carrot at the beginning and then I give you the stick at the end. So the market is going to stay in check. The inflation boogeyman will always be there for the Fed. So, Now, that would be all for the introduction. So let's move into the charts now. All right, so let's start out with a little bit of a look at the DXY alone individually. Now, no surprises here, right? It kept on pushing to the upside this week. It had a little bit of a pause the previous week, and this week, especially after Wednesday, Thursday, and Friday, it kept on pushing for a new, would you call it internal structure high, right? Because we didn't really broke out of this one, which in my view, it's kind of the relevant one for this structure. Because, you see the trend, it's going down like this. I mean, this line is kind of shit, but if you imagine some sort of a trend line going down like this, right? Up until the point we are not really out of this one, we are still in a internal range liquidity, the way I see it, right? Yeah, you could say, but this is where the trend is actually changing. Maybe, if you're looking at it from the perspective of this is where we start to make higher highs, higher lows. You got your first higher low here, higher high, higher low, higher high. Yeah, but up until, it was kind of like in here, right? It was up until this point, it was a pullback, and then it kept on going down. And even in here, you have your first higher low and a higher high relative to this one right here, right? And then what? It kept drifting lower. So I think, since our new daily range was established with this low right here and this high right here, and we have been trading into it, I think up until the point we don't break this one, we are still in this long-term consolidation. The dollar, it's the DXY, it's building up this base. And I think, if we break out of it as I'm not saying it's going to get back to 110 or something like it, but looking at this structure right here, if we break out from the 9900 region, yeah, sure, you're going to have your stops along the way. Like you might see resistance at 101 and 6, maybe a bit more of resistance here, right? But eventually, I think we are going to get back to 105, at least this region. Now, it probably is not going to be all in one shot. And actually, I hope so, because when you see the dollar spiking, it's never good for the rest of the system. But I think there is the potential to kind of have this little bit of a pullback. Now, if you check, starting from January, or I mean the beginning of the year, right? What would be some sort of a bounce like that if you're just looking at it from a Fibonacci perspective? That would be like, 50% would be just like this, 103. The golden pocket would be 104.5, 0.6, something like it. So, I mean, it would be kind of your normal pullback at the end of the day. If you are, again, bit caveat, if you're looking at this structure, this downswing in isolation. Then, of course, if you zoom out to, I don't know, a 3, 4, 5 years chart, it might be different, but don't get too ahead of ourselves, all right? So I think what was supposed to happen and was what I was expecting for the last, at this point, few months, it's just 2 months, I think, that I'm talking about this potential bounce in the DXY. It is actually unfolding itself so far. Although, again, before we move on, remember this high, because I think that's where the things could actually start to change, right? Up until this point, yeah, it is a bounce, but still confined in the realm of this current consolidation, right? So let's have a look at the others. Obviously, the euro came down this week. Same for the pound, and sure, the Canadian dollar, which had this little bit of a pullback starting early in the week. We tested back into these previews. It was some sort of a base which originated this rally. And then we got this clean breaking point right here. So we kind of retested the area and we were rejected so far. This time around, even the Swiss franc kind of took a hit. It's not a major one. It's still in this range right here. It's not like it's tanking. But maybe it could be that we have a little bit of a confirmation that what we are looking at in the DXY could have legs, so to speak. But before being 100% sure, we will need to see even the Swiss franc kind of breaking maybe this trend line right here and starting to pull back a bit lower. We'll see about that. Anyway, the thing to notice is that divergence we were looking at in between the euro and the British pound, it's actually playing out. Like you see the British pound, it's a hell of a lot weaker compared to the euro, which didn't yet broke out off of this range. Still confined in between these previous apex and these previous fractal. Although, it looks a bit bearish, right? We got the bounce, faded once, another bounce, faded even at lower levels compared to the previous fade. And now it looks like we broke the lows. So, yeah, it looks a bit weak. But currencies, they do move quite slowly. So, yeah, you got time to assess them. The Japanese yen, it plunged once again. So, 154. Yeah. So I think at a point, we are going to see another BOJ intervention here. Maybe not tomorrow, maybe not next week, but I mean, if we get back, let's say, to 158, 160, we might see a BOJ intervention here, which again, put the weight on it deserves. Like, it's going to be temporary because, as I always say, yeah, central banks, they are almighty and strong and all the rest, but the market is way stronger than that. So I think at the end of the day, if this thing needs to go down, in this case, the dollar up against the yen, therefore this chart will be going down. If it has to, because the market wants to, it will. So, let's have a look instead at the other currencies. Again, in here, there's really nothing to look at. Chinese yuan, it's basically at the same levels. It opened up the week and kind of closed the previous week, minus or plus or minus a few pips. South African rand, kind of same. What's next? Brazilian real, yeah, it had the dump, quickly bought up, and now it's moving in this range, so nothing new. Australian dollar, I'd say again the same. And the Indian rupee, once again, it's really the weaker of the pack. So nothing new. Ruble, yeah, rejection, another bounce, still same type of resistance level, another rejection. Although, you know, at the very least, it looks a bit constructive, right? 2 rejections, but we didn't, for now, at the very least, make new lows. So maybe we just go sideways in here for a bit longer. So let's move into oil now. Now, look, oil was interesting. If you remember, the assessment was switching from bearish to neutral, even in the short term. So what we got, it's a rejection starting out the week at previous resistance level, but, you know, not a lot of follow through. It was basically one day where you printed a very pronounced down candle, and then it just went sideways, kind of holding up this gap that was created previously on. I remember there was an announcement about something. Oh yeah, sanctions, right? Sanctions on Russian oil, right? So for now, it's just going sideways. I think I would keep on maintaining that neutral stance up until the point, of course, we break it to the upside, reclaiming this level right here. It's basically the same as last week. Nothing really changed. Like, we just had a sharp move up, which was rebalancing the sharp move down, and we are now working into this range. So up until the point nothing changes, there's really not a lot. Now, for the very long term, you might want to dig in what would be the fundamental or factors which could move this market up or down. I think, there is really not a lot to be uber bullish. But again, at the same time, you gotta tone down your bearish sentiment at this point up until the market shows signs of willingness to keep on going lower. And with commodities, especially energy commodities, with all the geopolitical implications and potential impact, I would just say for now, I don't feel biased one way or the other. We'll see. It might change next week if we actually have some new price information or something which is changing. But for now, not a lot. Let's have a look at gold. Boy, oh boy. I mean, I'm not regretting it. It was a good buy in this region right here. But again, maybe I jinxed it, because I remember I said, well, and then if on Monday I see another drop, especially starting out in Asia and then being kept around in the London session, maybe that's the time where I will need to exit the position. That is basically how it ended up. As soon as you see it's not really a gap, but it's at least not on this time frame, but still, it's an open which is decisively bearish on a Sunday night. And then throughout all London, it just kept on going down. It took out the Friday's low, and from there it was snowball, and it kept on going. So yeah, I had to scratch that position out. Wasn't a major loss, obviously. I didn't even take the full loss I was prepared to take. So I said I was starting buying 4,050, 4,040, 4,030. I collapsed the entire position down at 4,010, something like it. So yeah, on a macro scale, on a larger time frame like this, you can call it a scratch. It's not bad, right? So the point is now that we are living below the 21 exponential in, well, it's not really yellow because otherwise it wouldn't be visible on a white background, but you can see this, right? We tried to get back to it, and so far we have been rejected one time, 2 times. So we'll see on Monday. Monday is probably going to be critical, especially because what you don't want to see, it's the blue line, which is the 8 exponential moving average on a daily time frame, crossing to the downside of the 21, the yellowish, right? Because that would actually trigger some sort of a short-term bearish bias, so potential for another move lower, maybe to the 55 exponential. It was kind of cool to see that we still, let's get rid of the moving averages right now. Like if we zoom in, even with a drop, then again, as you can see, that there was this tiny little Sunday open gap, but it's just visible on the hourly time frame maybe. Market moved up, as you can see from this spike right here, filled in, and it just kept going. So when you see something like it, you know that that is conviction on the side of the sellers. And we finally bounced, kind of like we did in here initially. So look, if you look at these, right, these signature right here, all right, and the accumulation up, and then you look at these signature right here, there is a wick to the upside, and then a very large candle to the downside, and then reaccumulation. So it's the same type of structure. We touched into it, we came into it very inefficiently, therefore we bounced. And we spent the rest of the week basically trading in this dealing range right here. So we moved out from this one and we established a new one. If it keeps on going, I mean to the downside, that checks, that ticks all the boxes for a very ordered and structured redistribution, right? So, you know, naturally, I think it's, you know, if the downside keeps on going, I think we have the potential to get back to 3,700, 3,800, something like it. Let's move back to the daily time frame. Yeah. This region right here, it wouldn't be bad. One of these two. So might be 3,700 or 3,800. So what you do, oh, well, you go in the middle, 3,750. Maybe that could be the next area for a good and decent bounce. But, you know, for now, I'm not really liking it. Although, again, as we've seen, if you remember the equity market, we were looking at the same thing when we got that drop. When was it? 2-3 weeks ago, maybe, all right? So up until the point there is not this cross of moving averages, nothing tells you that on a Monday morning, you will see this market moving to the upside, getting back above the moving averages, and from there, kind of reaccumulating, going sideways a bit, and then pushing again. So I would say for now, it looks bearish, but it's kind of those do or die moments, all right? So again, I get back to the beginning. Monday would be kind of crucial for me to assess what could be, you know, the path for these assets from here to basically year end, right? So I guess we'll see on Monday, and we will be back to it next week, assuming the market will actually make a move one way or the other. All right. Now let's have a look at Bitcoin. Boy, oh boy, Bitcoin was another week for, I mean, you really have to love this shit. I always joke about Bitcoin, that's me, but I mean, we tapped back above this high and we immediately rejected, but at the same time, we didn't make new lows. So what's going on? If it keeps on going like this, you know, to be fair, it kind of have the potential to depict some sort of an ascending triangle. So a reaccumulation pattern, very slow, very grindy, very choppy, but nonetheless, for the long term, it should be good. Now, let's remove this one just for the sake of not imposing ourselves a bias, right? And let's have a look at the chart for what it is. And what it is just a choppy market. It's not really going anywhere. Now, when I think about it, right, I think it is strange that in a period, and I'm getting back a little bit to that narrative we discussed last week, the debasement trade, right? In a period like this, everyone is talking about debasement. And so why, just when they start talking about it, or let's say it goes viral, it goes mainstream, what would you expect? I mean, if you don't know any better, you would say, well, so again, hard assets would be skyrocketing. Instead, that's right the time where gold pulls back 10%, Bitcoin is not able to make new highs, and actually every time it gets to new highs, it's rejected. And then what? And then if you think about hard assets, if we step back a little bit, isn't this one an hard asset? Why in a debasement trade something which is priced in dollars, if the dollar is debased? Why don't you see oil spiking to the upside and going up and up and up, right? So again, I always wrestle with these logics. So I just think, as I said, that at a point narratives will have to give in to reality. And reality it is speculation. Now, I think at the end of the day, if you're looking at it in the overall context, it's not that bad. It's just going sideways, right? Is it, like, if you're into it, is it phenomenal to stay in? I mean, I guess it's a roller coaster of emotions. It's not really like the previous 2 years, maybe. But hey, the market never goes in a straight line. And although you might have been brought to think that only cryptos can do it, they don't. They got their periods. So again, nothing to say in particular about this one. If not, again, same type of levels, right? You got this level to the upside. We tried. We are rejected for now. To the downside, I mean, you could take that trend line, right? And up until the point you are above it, it's all cool. If you start making your lows, then, that's obviously bad, right? So, I mean, it's one of those moments for me on a much higher time frame, like the daily or maybe even the weekly, where, just wait for the market to do something. And as complicated as it might sound, because we are in a ranging market and every time it seems like, oh, this is the moment it goes. Oh, no, this is the moment it dumps. And then it goes back up, right? Just wait for the market to do something. This level, this trend line, either of the two might be good, right? And then at least, you got something to work off of. Otherwise, you're always going to chase the market higher and then lower, and potentially getting in and out at the worst possible time. So not a lot to say on this market for now. Moving along, let's have a look at the yields. Now, yields, not surprisingly, you remember we were discussing this pattern, right? Sharp move down, reaccumulation, move up, throwing back the leg, filling in, and then redistributing down, sharp move down. What are we saying? Possibly filling in this inefficient leg to the upside. It looks like we had it. Now, of course, you might say, well, yeah, okay, but it was data-driven because Powell was talking and all the rest. Yeah, maybe it is, right? Absolutely. I'm not saying that the market in the very short term, it's completely discarding what Powell is saying. But what I would say is that maybe, since I've seen it in the past, and it's kind of always the same, obviously, it's not 100%, but oftentimes it's kind of the same, right? You get into some news event which is priced in because the Fed, again, as I said in the beginning of the video, they telegraphed this cut like 2 months in advance. So what's going to happen? Everyone is short rates or long the bonds, the treasuries. What's going to happen? You sell the event, right? The market was already looking ahead. And now that we have the cut, you just take the profits, right? Now, let's have a look at the 2 years for a minute, if I can say it without stuttering, for a minute, right? It's still at around, what, 3.6%. So still way lower than where Fed funds is, right? Because I just forgot, where is Fed fund? Current, 3.754%. So yeah, the range is that. But it's almost 25 basis points lower compared to the lower end of the Fed fund range. So I think even with these bounce in yields, the bond market is still pricing in lower rates. Talking about, rates as Fed funds, so those established by the central bank. It's going to be interesting to see if over the coming month of November, you will see, yields keep on going lower. Because that's where if Powell was putting up his best poker face, saying that the December cut, it's not a foregone conclusion. If you see, especially the 2 years, right, keep on drifting lower or moving lower anyway, so let's say you fast forward 20, 25 days, and you find out that this chart right here, it's not anymore at 3.6, but it moved down to 3.4, 3.3. At that point, you know that they are probably going to cut in December too. On the other side, if you see it starting to maybe kind of reversing the short-term trend, so as we were discussing for oil, starting to get back above 3.6, 3.7, it would be in this case. And in this case would be, 4.2 for the 10-year, right? So if you see yields moving higher, getting into December, then you might say, okay, the bond market is actually giving the Fed the green light to pause, right? So always look at the bond market and don't listen to all the Fed zombies talking every once in a while. At the end of the day, they are going to do what the bond market is already doing and is already signaling, right? Now, the other side of the coin, of course, are treasuries, which were sold off, obviously. But again, it's just the same dynamic, but in reverse, right? So it's not completely surprising to me. I think, at the end of the day, there is not a lot more to say. So I'm going to take the usual brief pause, and then we're going to get back to it with the equity market. Now, having a look at the stock market, I just want to invert the two. Like this week, you know what we're going to do? We're going to look at the slides first, right? What's that? No, not Discord, the slides. Oh, yeah, there we go. Just to change things around. Now, so if you want a few things for your bearish pawn lovers, right? What you're going to see is that, of course, this is just updated to June, so we are much higher now, but we are pushing more than 2 standard deviations above what it is the natural, let's say, trend for the Buffett indicator, or, the safe read that you would like to get in order to determine if the market is expensive or if it's cheap and all the rest. And it looks like this market, it is particularly expensive relative to the historical trend, right? Now, that would suggest, of course, that, the market is getting a little bit ahead of itself, right? Now, that is true. The problem, again, is always that you never know when the top will be in. So, as we said in the past, you keep on dancing up until the point the music is playing. If you are a bit worried, maybe because you kind of feel like you have that feeling like, hey, but these are the songs that they usually play before sending all home for the night. So the party is almost over here. And maybe you move closer to the door, right? That old analogy. But at the same time, if you get out too early, you are missing out in opportunity cost terms or in sheer returns, right? Because even if you believe, as I do, quite honestly, that we are in a bubble, the last stage of the bubble, it's where most of the gains are done. And then, of course, it bursts, it pops, and that's where most of the losses are actually materializing themselves. But nonetheless, you really need to be nimble. When we talk about investing, of course, I'm not talking day trading here. Obviously, day trading, you don't care of all this shit right here. You're just capturing 15, 20, 30 points at a time. So who cares where the market is, right? If you are day trading, it doesn't really matter if the S&P is trading at 7,000 or if it is trading at 1,000. Doesn't matter, right? As long as the tick value is always the same and the volatility is good, you can do it. And same goes for all the rest. Gold, Bitcoin, you can always trade that. It doesn't matter where they are as for the price level, right? So that was the first one. Now, moving on. Again, this is really strange. Do you remember how many times I have shit on the Russell 2000, right? Those of you which followed me for a long time might remember that I still have the emoji with the face vomiting on the Russell. And it's not... Look, it's not because I do hate small caps. I just think over time, they're not a good place to be. I'm just saying the thing is that since the April lows, they actually not only performed particularly well, like better, for instance, than the Dow Jones, right? And kind of neck to neck with the S&P. But the thing is that in between those companies, those with negative earnings are actually outperforming those with positive earnings. So it is, to me, a sign of speculation, quite honestly, because instead of relying on fundamentals when, placing your bets or putting your money in, people are just betting maybe on those undervalued, quote unquote, stocks, expecting huge runs and therefore bigger returns. I get it. There will be, as it was in the past, there are those phases where even stuff which really doesn't have any reason to exist can actually rally. All right, and if you have been in the crypto market with all the altcoins there are, you might have seen this phenomenon playing out at a magnitude 10 times, 100 times more than this. But the point is that it's just temporary. So don't be fooled by it. If anything, I think it's just another sign of huge speculation and huge complacency. Everything is going up, so I'm gonna buy the most ugly shit that I can find in this market because, hey, if everything goes up, even the shit will go up eventually, right? So again, another point which is not particularly enticing for the mid to long term and the sustainability of this up move or this uptrend in the stock market. But again, it's not a timing tool, so don't go short the market tomorrow, all right? Now, and again, this was cool as well. Look, if you know anything about about the Dow theory, right? It's almost 140, 150 years old at this point. No, maybe a little bit less. It was, I guess, Charles Dow came up with the theory at the beginning of the 900s. So, 150 years, 120 years, more or less. Quite good. I think, although you might think of it like when he came out with that, the majority of the US economy, it was mainly manufacturing and industrial. Today, it's much more oriented towards services. It's a consumer economy now, right? And 2/3 of the economy are actually represented by services, not manufacturing. But nonetheless, if you just look at the transportation sector, because even if you are just consuming, you will need people to move around those stuff, whether you are importing them from abroad or the few stuff that you keep on manufacturing domestically. If the economy is good and people are actually consuming, they will need someone to deliver that stuff to them. So the transportation index or component in Dow theory, it's still kind of relevant. And in this report, they just said truck transportation. Oh, that's pretty much self-explanatory, right? Now, again, it is just another divergence, right? So basically, the stock market is going higher, but the transportation index, it's trending lower, and it creates this divergence. And at a point, as we all know, divergences will need to be kind of filled in or corrected or fixed, whatever. And they can always or only be fixed by one of the two, in this case, the blue line coming down or the black line going massively up. So either you have a huge economic growth to match up what the stock market is pricing in, or the stock market is pricing in something which will reveal itself to be just a mirage, and therefore the market will need to be repriced lower to match up economic realities. But again, we are talking long term. Sometimes it takes weeks, takes months. So same caveat, don't go shorting the stock market on Monday just because of this. You might want to short it for other reasons, but not this one alone, right? Another one would be another check on the breadth of the market. So here we are looking at a chart which represents the amount of stock or the percentage of stocks in the S&P which are above or below, in this case above, as you can read, they're respectively 150 days, 75 days, and 50 days simple moving average. Just to give you some sort of a broad look at how different parts or different sectors of the market are actually performing, instead of just looking at the S&P and saying, oh, well, it's going up, right? Yeah, I mean, it's going up, but if you only have the Mag 7 really overperforming and all the rest of the market, the other 493 companies are actually struggling, it's not a good indication when it comes down to the sustainability of that rally, right? So just another tiny bit. Again, I said in the beginning, that was just bearish porn. But there are a few highlights here and there for the bulls as well. Don't worry. This is not one of them. Of course, when you look at the S&P against the equal weighted, another type of divergence, which again, it's just another testimony of the huge concentration that we are looking at. And again, it comes down to the same old thing, right? Which is passive investing, which is based, of course, on market cap rather than pure fundamentals, right? And it creates that loop, right? Everyone is buying the same company, so the company goes up in market value, and by the dynamics of the passive investing, which is weighted by capitalization, not value, more people will pile in the same stock because, well, the market cap went up, all right? So we keep on buying. And what happens if we keep on buying? Market cap goes even higher. So next time we got flows of money coming in these ETFs and whatnot, well, they are going to be distributed unequally, and they're going to end up going in the same stocks, right? And, maybe, right, there are other stocks which are not benefiting from the same amount of flows, but would have much better fundamentals as for valuations, as for potential of growth and all the rest. So it's just another distortion which is added to the current market environment, right? This tweet was great. I mean, I just think, yeah, I like that. It's just self-explanatory, a good recap. So what do? Cap weight? Oh, well, you die. that was actually great. Of course, it's an hyperbole, right? Don't take it literally, but just to prove the point, right? Now, although, here's one of the most bullish things of the slide. From a seasonality standpoint, we are getting into the two best months of the year. So, the Santa Rally narrative and all the rest, right? And it's nice. They give you the normal trajectory and the post-election years. And remember, 2025, it's still a post-election year. When was it? November 2024? Yeah, and then Trump took office on January the 20th, 2025. So yeah, it is a post-election year. So, I mean, at least from this standpoint, should be good. Then what? Well, this is just for the sake of it, right? I mean, can you really believe in this stuff? Maybe. I mean, over a long enough period of time, you say that history doesn't repeat itself, but it often rhymes. But, you know, I've seen so many charts like this when you take the current price action and you compare it with what happened in the past. I mean, maybe the end result gonna be the same, but you know, it's just the trajectory from here to there. It's not guaranteed it's going to be exactly the same. So be careful. But again, it was just a nice representation of what could go on in the coming years, maybe, right? So again, back to the old theme of the AI bubble and all the rest, right? Now, anyway, when it comes down to the speculation, as you can see, the retail trader, especially when it comes down to options, I mean, they're really going at it. They are actually surpassing the institutionals right now. So, I mean, again, it's just, you know, risk appetite is going through the roof, as they state. So, yeah, that's another thing to consider, right? Now, on the flip side of that, as again, this is another thing we hinted at in the past, like, you remember the retailers that they were buying every single dip, while instead the institutionals, they were kind of holding back. And actually, there were a few periods where institutionals were sellers, net sellers. And what was the assessment, if you remember? Well, I mean, if this thing keeps on going on, there will be that breaking point where, you know, institutionals will have to give in. If the market keeps on going higher, they are going to have to play catch up because of career risk and all the rest. So maybe, I'm just saying, if you want to pair it up with the seasonality, right? Maybe this is the time where the institutionals wake up and say, look, we need to participate in this market at this point. We need to catch up. Otherwise, you know, we are going to face the very difficult situation where we need to justify why all these guys from their bedroom at home overperformed us, and we are the professionals, right? So, yeah, I think, you know, it might be a phenomenon that we could see if, again, the trend of the market stays intact, right? Of course, if you wake up 2 weeks from now and the market is tanking 10%, well, then maybe not. But at the current trajectory of the market, it could be something that you will see playing out getting into the middle of November and then into the end of the year, right? Just bear in mind. And again, we get back to the passive investing type of a quote-unquote problem, which, I mean, it is a problem because it just distorts the natural tendencies and dynamics of the market. But if you're just looking at pure price appreciation, this is actually your friend, right? It's the so-called infinite bid, right? Now, it doesn't end well. We do know that. But again, up until the point it lasts, it's just because the problem is that when it reverses, right? When it goes in reverse, what's going to happen? Everyone is piling in based on the market cap. So everyone is basically in the Max 7 and a few other companies. And they are becoming the most predominant part of the index. And we know by looking at the equal weighted that the rest of the market is not holding up that well. So when these flows, passive flows actually reverse, what do you think they're going to sell? It works the same. If they were all buying the same 7 stocks on the way up, they're all going to sell the majority of the amount, right, in those same 7 stocks, which are now a huge chunk of the index, percentage-wise. And the rest of the index was already performing kind of poorly. So that sets the stage for a sharp reversal. Again, usual caveat, it's not happening tomorrow, most likely, maybe not even next week, maybe not even next month. It's just one of those things where you take a note, you post it on your desk so that you know that at a point it's going to happen. So that morning when you wake up and the market is down 10% overnight, you might say, this is it. Yeah, kind of joking, right? It's kind of a practical prank. But anyway, that doesn't make it less true. At a point, this is going to be a problem, which is going to come back biting you in the ass, right? Well, not only you, the overall market, right? So I think we are done with the slides. So let's have a look. And again, let's close this down. Nobody wants to look at these. Let's have a look at the charts. Now, the equity market started out good for the week. We have a Sunday open gap to the upside, because as you can see, this is Friday on the left. So we gapped up and we kept on rallying into Monday, right? Now, getting into Tuesday, we had a little bit of a sideways overnight session, a London session. And then when the market opened for the New York session, a little bit of a pullback and up we went. And we closed the day around the highs, more or less, right? And same on, what was that? Wednesday, right? So on Wednesday, we got a push higher overnight, and then the market went, a little bit sideways, as you can see, made new highs, came back down. So we were starting to see a few wishy-washy action. I think it was mainly because Wednesday we started earnings, especially for a few of the Mag 7. I think Wednesday was what? Microsoft, Google. So, I mean, we got some big names. And it transitioned, of course, into Thursday, right? Actually, we can have a look at that if we want to. There you go. So we got, after the close, in fact, that volatility was at the end of the day. So we got Microsoft, Meta, and Google. And then the following day, we got Amazon and Apple. By the way, parentheses, there was a mixed bag result, right? We have seen, for instance, Meta dropped like a lot. Google actually gapped up and kept on going. Amazon was good, I guess. Apple went up initially and then it gave it all back. So, it wasn't a clear type of pattern, although, earnings were good. Actually, we are looking at one of the highest on history rate of beating for the earnings expectations. So, And then eventually what we got on a Thursday, we had a huge drop, which again, before the end of the day, if you can notice the dotted vertical line here, before the end of the day, it was mainly reabsorbed for the most part. And then on Friday, overnight, London were up, and then distribution down into the New York session. Tiny little thing, ES took out Thursday lows, NQ didn't, and of course, well, the Dow did. So NQ is a bit stronger right now, which could have some implications getting into next week. Now, let's zoom out a little bit. Now, I'm using RTH, so regular trading hours, right here, standard times. This is not the ATH, so you're seeing a lot of gaps, obviously. But just to have a little bit of a overall look at it, now what you see is that, there are all these gaps to the upside, right? And then, a few of them were already filled in, but you still have another one, which for NQ futures would be this one right here, and potentially another one right here. For ES, this one was almost completely filled. I think there is just a tiny portion of it, but I would consider it filled. But you got another one. Now, so the problem, what could it be? If the market is about to keep on, going ahead with this pullback, we might expect to see it kind of like this, right? So a pullback into this old area right in here, these previous highs, both for, ES and NQ. Now, obviously, NQ has more to go if we want to, because it went a bit higher compared to ES. The other two, again, the Russell, it's still just consolidating. And the Dow, it kind of shows the same thing, right? A tiny little gap, which was partially filled. We would have, even in this one, we would have a gap and some previous structure right here. So maybe if we keep on pulling back, could get back into this previous area. I think, you know, the possibility is there. And then, you know, this would be the decision point, because we broke out to new all-time highs, right? Quite impulsively, because 2 gaps in a row, almost 3, right, in a row. It's just a testimony that the market, it's really going, it's really pushing. And I think most of it was, of course, on the back of what came out at the beginning of the week with the US and China kind of getting into a framework or an agreement for the, you know, the trade relationships. So you're going to buy more soybeans, I'm going to lower the tariffs and all the rest. And of course, the market was particularly enthusiastic about it. But then what we had, now the narrative would be, okay, it was news driven to the upside, and then Powell took that certainty of another cut in December away, and so it came all the way back down. So it's just 2 tape market on 2 main events, all right? Now, you might believe so, and I guess, you know, obviously there was an impact by those announcements and those events in the real world. What I do think instead is, of course, they obviously played a role overall, right? But I do think that at the end of the day, right, we went up. So we were particularly deviated, even from a very short-term moving average like the 8 exponential, if you can see in here, right? So we just broke out, came back, some sort of a mean reversion, and now we see, because, you know, funnily enough, that previous structure at the highs, lining up with the gap in here and the gap in here, at this point would also line up with the 21 exponential. So if early in the week you see a further drop, but this area right here overall, or right here overall, it's held, and the market can, you know, base off of the area and keep on pushing. I mean, we are still on the go for more upside, I think, right? And as we were discussing in the past, these moving averages might be just a simple tool, but when it comes down to the trend identification, they can help you out a lot. Like even in this case, that was scary maybe for someone, but there wasn't ever a cross. So you needed to stay calm. And then when the market pushes up and reclaims the moving averages, well, you know, that is good. And then what happened? We pushed to the upside. So for now, don't be worried, all right? I think, if anything, if we bring in the indicators, right, we might see a bit of divergence on the RSI. The stochastic actually crossed down on this recent drop. So again, maybe the possibility of a continuation of this drop, retesting the previous highs, it might be in the cards. But up until the point you don't have a structural break, I wouldn't be so worried. Like I wouldn't call a top or a trend reversal or anything like that. It's just, you might have the how do they call that? Limited upside potential, which I know it sounds crazy when you look at a week where we went massively up just on a Monday open, but if you look at the overall structure of the market, getting back to what, the end of July, it's always been like that, right? So it goes up, comes back down, then it goes up, comes back down, goes up, back down, a little bit higher, and it comes down, higher, comes down, it chops around for a week or two, and then it goes higher. So just this is the current tempo of the market. So don't lose your head over every single daily candle. Just try to look at things in the grand scheme. And the grand scheme, at least for me, is saying that for now, nothing really changed. Although, and no matter, all the risks we were looking at in the slides, as we always do, always be mindful about the risks, right? It was a week where, again, you got a mixed bag of results because, Nvidia was up 10%, Google almost 10%, but at the same time, Meta was down 12%, Oracle was down 8%, right? So again, even the financials, right? You got Bank of America and JP Morgan up 5%, but at the same time, you got, let's say, Visa down 2%, MasterCard down 4%. So again, Walmart down 5%, or Amazon was up 10%, right? Another one was, I think, I've seen Chipotle took a big hit. I don't know where it is. Can't find it on this chart. It's too small and I'm too blind. But I mean, just to prove the point that as we were looking at in the market cap weighted and equal weighted comparison, there is a bifurcated market right now. And there are a lot of things, especially in between earnings seasons going around. But we come off of earnings season. We get back to the corporate share buyback window being open up again. That would bring in another buyer for the market. The trend still up, as you can see, although some minor divergences in here, right? Seasonality is on the bullish side for now. So, I mean, don't panic. There is absolutely no reason to panic. We just scored new all-time highs, and you know what happens historically. New all-time highs calls for even newer all-time highs. So just be cool. It's all fine, right? And it is absolutely crazy that you need, it feels like you need to come here and reassure people that the market is still fine after we just printed a new all-time high like 4, 5, 6 sessions ago. It's just that all, you go on social media, you go on YouTube, and I like YouTube a lot. Like I don't know how many contents I consume on YouTube. I'm gonna tell you, 60 to 75% of what I'm looking at is fucking bearish. This is the end of American exceptionalism. This is the bubble bursting, the deficit, the debt, the basement of the currency, the stock market, the higher valuations, or everything. Or those titles like the biggest crash in history is upon us. Yeah, maybe, all right. But what do you mean when you say upon us? Do you mean next week? Or do you mean in another 2 years? Because there is a big difference there, right? So just try to sometimes eliminate the noise. Although, I'm not going to lie, I do like those contents. And I do believe when they say that, fear sells, that is absolutely true. I'm more enticed in looking at a video which has a thumbnail which is catastrophic than looking at one where they just show a man comfortably sitting in his desk with a very satisfied expression and a thumbnail which goes, best bull market ever. Yeah, no shit, Sherlock, I already know that. I can just look at the chart. Tell me what I don't know, right? And therefore, that's where if you see someone with a red background, a chart which is going down and crashing, and all the percentages with the minus in front of them, you might entice into thinking, hey, what am I missing? What am I risking here? Maybe I should listen to it. We all fall for the same stuff at the end of the day. It's just human behavior. It is human psychology. The difference is that after I watch that, and after many other people watch that, they come back to the desk, they do their homework, they look at the chart, and they say, yeah, nice content. I enjoyed it. Fuck you. It's not what the market is telling for now, so the market is always right. Now, after that tiny little main rant, I'm going to call it a day. I'm going to wish you all a good rest of your weekend and enjoy, right? We're going to catch up next week for another roundup. And up until that point, be nice and be cool as usual. Neil's out.
Shit, this is really going to affect people.
Yeah, it's going to affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. people want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, you know, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. You know, the funny thing is, tomorrow, if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well, then the same people are gonna laugh till they piss their pants, because we're gonna look like the biggest pussies God ever let through the door.